Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Happy Monday.
Yes, sir. Yes, sir.
Oh my gosh. Monday, June 9th. Got a lot of things happening, lots in the news. What we're going to do right now for all of y'all listening to this or watching this, Tom and I are going to create a library of all of the things that you need to know about each type of loan. And today we're going to start with conventional loans. So Tom's going to ask me questions. If you have questions, call us. All of our contact information is attached to this. Today, the most common loan, the gold standard conventional loan. Let's talk about what that even means. What is a conventional loan? It is a loan secured under the guidelines of Fannie Mae or Freddie Mac, sometimes called conforming. It conforms to their guidelines. So I don't care if you're Bank of America in Hoboken or you're Fifth Third in Miami Beach or you're cross country. Fannie and Freddie set the rules and we just interpret what those rules are. Some lenders add overlays to that, and in order to mitigate risk, they'll add additional layers of rules, but those aren't the guidelines. For us, we are what's called an agency lender, no overlays.
Let's talk about that for a second, Bruce. Let's talk about the overlays, because that's going to be the difference between one lender and another. Why would a bank choose to have additional overlays, and then what would that impact be on the borrower?
It could be any number of things. And generally it's down payment. So if they're trying to mitigate risk, maybe they've had some problems, they may increase the down payment requirement on a loan. They may increase this credit score requirement. So Fannie Mae may say, we'll take a loan for a 95% conventional loan with as low as a 620 credit score. But the bank says, when we do 620, our defaults go up by 70%. When we get above 675, they decrease. They create an overlay to reduce the risk, because if a loan defaults, even though it may meet Fannie Mae guidelines, if Fannie Mae has purchased the loan or insured the loan, they're going to make that bank take it back with penalties.
Right. So correct me if I'm wrong, but the overlays can only make it harder or require more. They can't actually lower the standard, correct?
For the consumer, it makes more challenges.
Now, is it safe to say if a bank is doing an overlay, let's say they've got a higher credit score requirement, would that bank typically have a better rate than a bank accepting lower credit scores?
Well, the truth of the matter is mortgage rates are mortgage rates on that day. They're purchased by mortgage-backed securities. So at the end of the day, I don't care who you are out there, whether you're shopping a broker or me or a bank, everyone's rates on that day should be pretty close to the same, because the government's not selling bonds to Bank of America cheaper than Wells Fargo or cross country. It is what it is on that day. It's just like buying a Google stock. It is what it is on that day. So when you think your bank or mortgage company is a better rate, it's probably because there's a different fee to get the rate up or down. At the end of the day, I would tell you that my rates were the lowest in the country, but they're not. I'm buying mortgage-backed securities. I make the process easier and we don't add the extra restrictions.
Got you. Okay. Why is conventional thought of as the gold standard when in reality, we close plenty of FHA and VA loans
without more problems? That is a misnomer. If a seller was reviewing 3 buyers, one conventional, one FHA, one VA, and the conventional buyer was putting 20% down, the VA buyer's putting 0 down, and the FHA buyer's putting 3.5% down, is that 20% a better risk to choose that buyer than the FHA and the VA buyer? And the answer to that question is no. They're not a lower risk at all. It depends on the quality. That buyer may have not enough reserves to cover his rental properties, or there's more credit score restrictions on conventional loans than there are on other type of loans. So the best client to choose is the one that qualifies the best. And that may be that the agents need to dig a little deeper, make sure that loan officer is unveiling the truth about each client. Because I can show you a veteran that's a better risk than a buyer putting 30% down on a conventional loan. You cannot tell. You can only tell by the quality. But here's why conventional is the gold standard. It's the only type of program that you can do owner occupied, vacation homes, and investment property. You can't do those on other programs. So FHA, only owner occupied, VA, only owner occupied. So conventional gives you a much broader spectrum of products to choose from when it comes to that. It doesn't mean it's a better deal or a lower rate. I'm oftentimes seeing VA and FHA interest rates much lower. And when a buyer might need closing cost concessions, Tom, and they need a bunch of money, if they're only putting 5% down on a conventional loan, the seller can only pay up to 3%. Or on FHA, they can pay up to 6% toward closing costs. Same with VA. It's not uncommon for me to tell a client that qualifies conventional, let's take a peek at FHA and just see if that might be a little better for you.
Yeah, I think I remember an FHA client that we had that put 20% down to not have to pay PMI, which is, you know, one of the things that people want to do when they go conventional. They don't want to pay the PMI. But FHA had maybe a quarter or more of a better rate that day, just because that's what it was.
The pool of money for Ginnie Mae, which is where FHA and VA loans, that's the government version of Fannie Mae and Freddie Mac. They may have a different pooling and the prices could be a little bit different when it comes to that. It's not always the case. Right now, government loans have a better interest rate than conforming loans, but that's not always the case. Sometimes that switches and goes the other direction.
If I'm a seller reviewing offers, I don't want to just assume that a conventional is the best.
No.
However, oftentimes the conventional is going to come with a larger down payment and a higher credit score. So there is a factor in there that I would want to know, right?
Credit score, debt ratio, reserve requirements. Typically, we don't need cash reserves on FHA or VA. I won't say that never happens, because sometimes if I have a loan that's not approving and I throw more reserves at it, when I'm running an approval, it can approve it. But they typically don't tell you we need reserves. Conventional has guidelines, and reserves are extra money over the down payment.
You can't come to home plate with no money.
VA will do that for a veteran.
Sure.
Right.
Sure.
So there are ways to do it. But I think that truly it is a misnomer that a conventional buyer is better qualified than an FHA or VA. I have more restrictions on credit score with conventional. I have more restrictions on down payment. There's more guidelines, more hoops to jump through. So is it better? No, it's not better. The best one is the best qualified buyer.
What about time frame? Does conventional take any longer or shorter than VA or FHA?
Some lenders tell you that they can't do an FHA or a VA in as short a time. To me, they don't make any difference. The only challenge is VA appraisers require 10 business days, which is 14 to 16 days. Generally, I'm not even seeing VA appraisers take that long. Sometimes they will. I can close a VA loan in 21 days, generally without any problem. I can close a conventional loan in 10 to 21 days if necessary. Most people don't want it, but we can do it.
One of the things as an agent that I am careful about, and conventional works better for me, is if I have a house that has a few things that might be wrong with it, especially little things like wood rot, some cracks in the sidewalk, substantial. FHA and VA appraisers inspect the property, not to the depth of an inspector, but to a surface level. They often require specific repairs that a conventional would have bypassed. If I have a house that's perfect, I can go anyway. But if I have a house that's questionable, conventional would feel better because I'm not going to have that
If
second
you have
risk.
concerns about condition, then
Mhm.
oftentimes conventional can have a little bit more flexibility. But one of the misnomers is that conventional loans don't care if it has deferred maintenance, and that's not true.
No, I
You know,
understand.
your insurance and PMI still require safe, sound, and sanitary. Got to be safe.
Absolutely.
Could I get away with a broken window on a conventional loan and not on an FHA or VA? Correct. I probably could get away with it. But if that picky conventional appraiser says, hey, this is a dangerous situation for a
Mhm.
child, then the conventional lender is going to require for that to be fixed anyway. So
Yep.
it
And
doesn't.
one more thing that conventional does have over VA, FHA, the ability to do condos. Not that you can't do FHA and VA, but it's very restrictive to do FHA and VA in the condominium communities, whereas conventional, it's a lot easier.
Well, there's more flexibility for getting condominiums approved conventional. With conventional, you can get the complex approved. With FHA and VA, you would have to get the entire complex approved. If it's on the FHA or VA list, it makes it super easy.
Then it's
But
easy.
there are some complications involved with that. But I will tell you, we got to be honest with your listeners. Condos are problematic with any kind of loan
Across the
right
board.
now,
Yep.
just because of the Florida requirements. They're all a challenge.
They are, for
Next
sure.
week,
Yeah.
we're going to cover FHA. We're going to dive deep into the pros and cons to each type of loan. Tom, I hope that was helpful. Tune in,
Yeah.
call Tom and I. Have a great
Bruce,
week.
sounds great. Talk to you next week.